All right, we are going to go ahead and get started. This is being recorded, so you will be sent a copy of the recording. Tonight, I'm flying solo on presenting this deal tonight. If you have any questions, put them in the chat. I may or not answer them right in the moment of when we're doing the call, but I'll definitely answer them by the end of the call. So can you give me a thumbs up, Max? Because I can see you, that you can see my screen. Awesome. All right, so this is a 506C investment opportunity, which means it's for accredited investors only. If you're not accredited, you don't have to leave. You just won't be able to invest and you'll have to wait for our next opportunity. So this is Edgewood Apartments. This is in Sealy, Texas. This is in partnership with Zen Vista Capital and Massive Capital. This is 136 units. And again, average return on investment is 19% internal rate of return and about a 2.2x multiple of the deal. So again, I've simplified my disclaimer. Investors should do their own due diligence before investing to understand the risk. Projections, returns, cash on cash yields, your return models are strictly the sponsor's best estimate. You may lose part or all of your investment. I am not giving you any legal, financial, or tax advice and liquidity. Your capital will probably be locked up for 5 years with no easy cash out. So again, this is a co-partnership. The lead sponsor is Shiru, and he is a very experienced person. We'll talk a little bit. We have another property that we're partners with him in the marketplace. You can see his whole bio here. He's been doing real estate for about seven years. He's co-sponsored about 750 units. He has 28 years of executive leadership position. And then on the Massive Capital side, Sanjay is the balance sheet and loan guarantor, and he provides all of the liquidity or part of the liquidity, the net worth, and the experience for us to be able to qualify with a loan. Sanjay is actually who I invested with 7.5 years ago for my first investment. We'll talk a little bit more about Massive Capital in a minute. And again, myself, I started passive investing back in 2018. I have been a limited partner, which is a passive investor, what I'm talking to you about today, in 20 syndications. And this particular opportunity is my 20th as a co-sponsor. 17 of those are with Massive Capital. And Massive Capital sponsors Massive Masters, and Charu is part of that. And what we do is we help people become general partners and do deals. So it's with Phil and Shanoa, who would read my original mentorship program I joined, and Olivia. And of course, I mentioned Sanjay. There's Mike, Shirar, and I got to get a new picture of myself because you'll notice I've lost a little bit of weight here. And again, with Massive Masters, if you hang out with successful people, they will brainwash you into believing in yourself and thinking you can achieve anything. So again, my personal goal is to help 100,000 people reach financial independence through real estate investing. I'm going to put my contact information in the chat. So there is my email, there is my cell phone, there is a link to book a Zoom call, and there's also a link to this particular portal where you'll be able to see all of the investment documents. So tonight we're going to go through an executive summary. We're going to talk about our proven operational experience. We're going to talk about the market and demand drivers. We're going to talk about the operations performance and the value creation plan. We're going to talk a little bit about the capital stack and the return structure. This has a little bit unique of a situation. We're going to talk about our exit strategy, when we're going to be closing. And there are a bunch of documents in the appendix. I don't go through a lot of them on this presentation because there are a lot of back-end detail, but you can see this deck on the portal when you go there, or I can email it to you so that you make sure you have it. So again, our executive summary, this is a 136 unit Class B multifamily. And again, for those that are new to the multifamily space, there's Class A's. That's the real nice new stuff. Class B is the pretty new nice stuff. Class C is usually referred to as workforce housing. It's older apartment complexes, usually garden style. And then if it's a Class D, make sure that you are armed if you're going to visit. I'm only kidding, but there are Class D apartments. And we're located in Sealy, Texas. Sealy, Texas is about 40 minutes west of Houston. And so this market is a real feeder market for people that are working on the west of Houston and that particular corridor. And the property is currently 95% occupied. Some of the things that are really important on the highlights for the investments, day one, we're at a debt service coverage ratio, DSCR, of 2. Lenders like you to be at least 1.25, so we are substantially above that. And then by the time we're stabilized and ready to sell, we should be at a debt service coverage ratio of about 3.1. As I mentioned, we are 95% occupied, but we are break-even occupancy is 74%. And I skipped over here, the agency leverage is 70%. We'll talk a bit about that going. And again, it's a great submarket with a high median income, supply constrained workforce housing. There's a lot of good things. It's a stable area. We will actually own 40% of all the apartments in the Sealy marketplace. We are purchasing this property for $12.25 million. Our total capital raise is $13.6 million. And so we are buying this apartment complex at $90,000 a door, which is a really good entry price for us to be able to purchase it at it. So we are getting debt of $8.6 million. We'll talk a little bit more about the debt as we get into the presentation. And we have two investor classes, and we've shown them here as $2.5 million each, but our total capital raise is $5 million. And so we'll go a little bit deeper into this, but we have an income class for the investors, and these are the ones that would like to get paid first. They are higher in the capital stack. So what happens is the bank gets paid, the people that have invested in income class get paid, and then the growth class gets paid, and then the sponsors get paid. So we don't get paid till everyone else gets paid. And again, up here, it is a 1.8 equity multiple, 16 ARR, and it's a 14.7 IRR. And then down here, we are 2.2 equity multiple, a 24.5 ARR, and a 19.35 IRR. And all classes will get bonus depreciation. We'll talk a little bit about that as we go on. So as I mentioned before, we do own a property. We're coming up to owning a property in Sealy for a year now. We're also partners in that particular opportunity. It is 60 units. It is also a Class B, but it's a very different. So this one is 16 fourplexes, where the particular one, the 136 units, is a traditional apartment complex. We've been able, since we've taken over and operating it, been able to pay all of the preferred payments, so it's all been being paid. We've reduced our operating expenses from 52% with the current previous owner to 46% of revenue. We mentioned before the DSCR, and this one starts out at a 2.0, and we've increased this particular property. We bought it, we were at a 1.65, and we've already improved it to a 1.85. The lender's the one that really cares the most about that statistic. And our delinquency was very good at 4% from the previous owner, and we've reduced it down to 1.5%. We've achieved a 3% rent bump, which we were only budgeting 2, and we've reached our net operating goal already for year 2 before year 1 is ending. A lot of this story goes to say this is going to be the same asset manager, which is Sharu. It's going to be the same property management company. It's going to be the same vendors. All of the people that we've been using and we've managed to reduce the costs down to 46% are all going to be the same group of people. And again, if you don't know much about Sealy, it's west on I-10. It's an affordable, commutable place for Katy in West Houston. There is very limited multifamily supply in Sealy. It is definitely a smaller market. It has a great school district. And again, Edgewood is positioned for rent capture with selective refresh on some of the ones. And the median, increasing the median income, it makes it for great affordability. There's the Tesla mega factory. It's actually being built northwest a little bit, where there's a lot of distribution companies that are on I-10 there. This one is literally less than a minute off of I-10, lots of different things that are happening within that marketplace. So this is a pretty busy slide, but we'll go over some of the highlights. So this is current where we are right now. The NOI of this particular property is 850,000, and that's on a T3 annualized. So what it basically, we took the last 3 months and we analyzed it over a 12-year period to get these particular numbers. So it is a 95.6% occupied. The average rent is $1,137. The current expense ratio is 52%. They currently have a 2.0 DSCR. Break-even occupancy is 74. So this whole middle section is basically our 5-year business plan condensed into a very small bracket. So our goal is to increase the net operating income by 280,000. So it brings it from 850 up to 1,131,000. And we're going to be doing this through vacancy improvement. So again, even though it's 95% occupied, that's a little bit misleading because there are 2 staff members living complementary on the property. We're going to be offering them a reduced rent to stay there for their first full next term, but we will be adding those to the rental market. And again, we're going to be doing a better job. They've been pretty slow on turning units and then refilling them. So even though they have a high occupancy, when you can speed up the releasing, it can have some great improvements. Another thing we're going to do is we're going to lower our concessions and improve collections. So again, those are things. So some of the things we're going to do, we currently are at the property. They have this thing called the RUBS recovery. And that is basically where we're taking expenses that are now being expensed at the property level, and the property is paying 55% of those expenses, and the tenants are only paying 45% of those expenses. So our goal is, instead of getting major rent increase, we're going to go for RUBS recovery, where we add some expenses coming out of the expense bucket and go over into the income bucket. We're also going to be installing washer dryer connections. We've estimated about 80 units. We may not do all 80, we may do more than 80. The current owner was very friendly with us and allowed us to do a survey, and we got great response to washer dryer connections and carports. So again, the type of folks that are living here. And then what would happen is we would install, obviously, the washer dryer connections, which would be at a cost, and it's included in our CapEx budget. And then we will be able to put it to where we're going to be able to bill them. And we also have an appliance company. So if you don't have your own washer and dryer, we'd be able to lease those to you as a profit. And again, there are no car ports within the property. So we've already identified where we're going to start putting the carports. We're going to pick some of the premium locations. And of course, we're going to charge extra for parking in the carports, and with the added income of about $35 for a prime parking space. So again, we've said we're not really going to be able to improve the occupancy. We hope we can, but we want to be careful that we've been conservative on this, because they've been running in the mid-90s for several years now. So we don't want to be too aggressive. Our rents are going to go from here, 1,137 up to 1,255. And again, this is a progression. This doesn't happen on day one. This is a progression. We believe we can bring the expenses from 52% to 47%. We believe our debt service coverage ratio will be down. Our debt rate at this point here, we're at a break-even occupancy of 62%. And we are showing an exit cap rate of 6.25, which is the cap rate that we actually bought this property. So we've not changed that on the particular. So again, we have agency debt of 8.6 million. It is a 10-year fixed, 30-year amortized with 5 years of interest only. So one of the things that's very important to understand with the interest only, that gives us a lot of available cash flow, because we're only making interest payments. we are not making principal payments. And so that allows some cash flow where we can meet the demand of the preferred returns that we are showing within the particular property. And again, we have two investment classes, income class, and we have a growth class. And I'm going to spend a little bit of time on these ones here. So again, on the income class, these folks get paid first, and they get paid a 9%. I shouldn't say it's a 9% preferred payment. So if there's not enough cash to make the preferred payment, it accrues until it's paid. And then once they're paid at the very end, they're going to get 7% that's been accruing on exit. So the cash flow of the 9% will come through the life of the project, and the 7% kicker, it will come first cut out of the proceeds of the particular property. And again, they're going to get the bonus depreciation. This class here, growth class, is much more typical to what you would see in a multifamily deal. So again, this one has a 7% preferred return, and then it has a split on the end. And I've got a slide that shows a little bit more. And again, you're going to get the bonus depreciation and all of the different things. So this is the income class, just to give you an idea. So this assumes that you invest $100,000, and it's going to have a 9% distribution. So again, this class is the highest in the capital stack after the bank. And our goal is to pay them the $9,000 a year, 9% a year. So you would receive about $45,000 in cash flow. And then out of the first proceeds of the sale, you would be accruing your 7% accrued, which would be another $35,000 based on a $100,000 investment, which means $100,000, assuming we hit all our performance metrics, would come back out at $180,000. So that is an ROI of 80%. It's an annualized return of 16. It's an equity multiple of 1.8, and it's an internal rate of return IRR of 14.7%. So again, I want to make sure I don't like to use the word safer. This one gets paid first, so it has more surety than versus to say one is safe and one is risky. But I want to make sure that you understand the difference between the two. This is very traditional what happens on a multifamily deal. So what we have is we have a 7% preferred return. So again, I want to make sure I'm clear. We made sure we paid all our 9% first, then we're going to pay our 7% second. And the general partners will receive nothing until all of these distributions are paid to the paid to the investors. So again, you would accrue about $35,000 in preferred returns. And then we have a tiered split. So up to 18% IRR, it's a 70-30 split. And after that, it's a 50-50 split. So again, assuming we hit the metrics of everything that I've shown you on the particular opportunity, you would get about $60,000 on this split and about $27,000 on this split, which means $100,000 would grow to $222,000. That's an ROI of 122%, an annualized return of 24.45, an equity multiple of 2.22, and an IRR of 19.35. So hopefully I presented that clear. And then all of these are eligible for bonus depreciation. So a couple of things just to give you some more details on the numbers. Okay, so we're saying here how we're going to get this. It comes in basically three ways. We're only talking about a 2% rent increase that is built into it. We're also talking about we're going to do the vacancy improvement and better collections. $72,000 of our NOI will come from RUBS recovery. $97,000 will come from the washer dryer connections and the carports. All of these will be an additional charge on top of their rent to get them. So assuming we achieve everything in the plan, this will increase our net operating income by $413,000. It will also decrease our expenses by $107,000, which works out to $310,000. And then again, just to make sure we're conservative, we've reduced that down to 280, just taking a 10% cushion, because again, if we put 70 carports in, 65 washers, whatever it is, we want to make sure. And again, these are all the employers that are in the area. So there's the Houston, Texas Medical Center. Oil and gas is all along there. There's the Amazon, there's Igloo, Rooms to Go, Target, Walmart distribution. There's a lot of things that are on here. And just so you know that 70% of the Vale residents, that's our first property, and 2/3 of Edgewood residents commute east towards Houston. So again, a large portion of our population is driving east to go to Houston to work. So again, all of the units are classic. And at this point, we have not built in doing anything other than refresh on unit turns. There is the capability that we're going to test some units with some upgrades, but I'm going to be honest, most of this is we're trying to get our money from the carports, from the RUBS recovery, and from the washer dryer connections. We're going to focus on that first. And then once we achieve success there, we're going to focus on perhaps renovating a few units to be able to get a bonus, an increase in rent. And this will actually be where we'll probably only do 10 to 20% of the property to prove the plan. It will also increase the NOI while we do it, but it will prove the plan for the next buyer. And again, our loan, $8.6 million, pardon me, we're a fixed interest rate. It's all locked in, 5.65%. It's a 10-year term with a 30-year amortization. And again, 5 years of interest only. That's a very good loan in today's lending environment, which again shows that the lender has great confidence in us. And a lot of that has been achieved through us being able to demonstrate with our existing properties that we're able to do it. Our total CapEx budget on this property is $530,000, with the majority of that money focused on the washer dryer connections, car parts, ports, and selected appliance upgrades. There are some units that will need appliance upgrades to make sure we're going to do it. The sponsorship team is putting in $400,000 of their own cash. And to make sure that they qualify for the loan, they're needing to leave $820,000 liquid. One of the things when you get a loan like this, you need to make sure that you keep some liquidity. The lender makes sure that you have that to be able to do it. This is a very overblown slide, and I'm not going to spend a lot of energy on it because it just is super overwhelming. But we're going to talk about how, when you're going to look at this in more detail, what we've done is we've split it into some ways that you can help do it, right? So again, a modest increase of the base rent, freeing up the employee, they shouldn't say owned, occupied units within that will increase income for us to be able to do it. Then we're going to take the utility recoveries up to 55%, and then we're going to grow it up to 75%. And then we're going to install the washer dryer connections and all the different things. This is here. We realize that our property taxes will be going up. So again, if you look here, we've said, okay, year one, we're going to be here. We put it up to there and up to there because unfortunately, even with winning protests, property taxes are going up. And we've had some year over year minor increases in expenses. And again, all of this will flow back down with our better efficiency to increase the net operating income. So again, you can see here, there are two slides at the beginning. This is the previous owner. This is his T12, and this is his T3 annualized. So the trailing 3 months before we bought it basically turned into 12 months. So just to make sure that you understand it. So we're really using this one as the base. So this one here, he's producing, $1.711 on total income and about $681,000 in expenses, creating that $850,000 NOI. Again, in year one, we're going to be building up because we're not going to have everything implemented by year one. So it goes up, under $100,000 to be able to do that. But we're going to start squeaking on the supplies and doing the RUBS build back, which will reduce our expenses from $861 to $846. but then we've basically caught up on the expense, and the expenses you'll see will increase over time because expenses increase over time. And then you'll see what it does to the net operating income during the period here. So again, our goal to bring it from 850 to $1,131,000. So again, this one has a lot of detail on it. You can get a copy of it. You're one decision away from a new life. And so again, we hope that you'd be interested in investing. So there are some things in the appendix that I'm going to show you quickly here, just so you can see it. This is the CoStar report, which talks about where we do believe cap rates will be. And we've done some sensitivity analysis here at the bottom, right? So again, this is what we've assumed here, that we're going to sell it at a cap rate with the NOI we predicted, and it will give the 16% annualized, the 24, the annualized. If it goes down 5%, it's going to reduce your returns. If it goes up 5%, it's going to increase your returns on the NOI, and same with the cap rate. So again, we've just put this in here so that you have some sensitivity analysis. So remember, all of our projections are our best estimates provided on how we think we're going to perform. And we just want to make sure that you know that we've looked through this. These are all the sources of the money, right? So it's the 8.6 million, the $5 million we're raising, the purchase price of the property, the acquisition fees, our total closing costs, and then this is CapEx and reserves. So if you remember before, we had about 520 in CapEx. The rest is reserves that the lender requires us to have on the property. This gives you an idea of the 4 main apartment complexes that are in Sealy. So again, we own Vale Apartments here. You can see the Vale Apartments are larger. They are 4-plexes. They are 2-bedroom, 2-bath apartments. They're nice apartments. They do well, and they are commanding a higher rent. This is Edgewood Apartments. Again, we're 763 square feet. And the other 2 apartments that are in our market are both A-class newer apartments. And you can see the years built, they were definitely built newer than our properties. This one has 75 units, and this one has 196 units. And again, one of the things to notice here is there's a pretty nice gap. We want to get up to the 12 something here. We've got a couple $100 a month gap between us and a A-class apartment. So again, we believe that we'll be able to achieve the rents that we've had in it. I'm not going to go through these particular ones here. So I did this one just trying to do a little shorter presentation because this is about our 4th webinar. But I wanted to see if anybody had any questions, wanted to see something in more detail. And again, a copy of this recording will come out. A copy of the deck is available on the portal or through myself. Any questions?
Are they able to unmute themselves, Trevor?
Yeah, you can unmute yourself, pop yourself in the chat.
You must have done a great job, Trevor, because nobody's got any questions.
Well, I have,
like
I have
Angel
a question,
unmuted himself.
and excuse my ignorance, but I did write down the RUBS recovery. I was wondering if you could go over that a little bit, and then servicing the loan, was that you put the P&L or the expense on there? I didn't see that. Is that?
Yeah, loan is after NOI. So debt payment comes after NOI. Good eye, catch that. Yeah, so basically net operating income is all of the property expenses, and debt and taxes and all those things are below that particular line. But again, we're at a debt service coverage ratio of 2, which is well above what's required. And we do have reserves in there. And the RUBS recovery, what happens is this is not an individually metered property. So again, very common in multifamily properties that are not individually metered is they do a bill back system. And we're going to be using a third party. And basically what they'll do is they look at all of the things that happen. And what's going to happen is your bill back is going to go from $30 to $45 to $50 to $55. So you will get those things added to your rent. But it's a kind of a misleader because the rent will list low, but again, on the rental agreement, it says we're going to recover these items. And then washer dryer connections. If you move into an apartment with washer dryer connections, that will be included. And your only other option would be if you lease the washer dryer for us. But if you were a current resident, we would ask you, would you like to have that added? Then we would add it, and then you would pay that $40 a month for it. And then on the appliances, we would be charging them about, I think it's $45, and it costs us $25 for the lease. So we make the difference, and the leasing company is responsible for installing them and repairing them. So it's a third-party service contract. And there's some other things that we have looked at, but we haven't put in there because at some point you reach a point where you can't nickel and dime to death, right? We could start looking at valet trash. We could look at lots of different options. But again, we've picked what is the lowest hanging fruit with the biggest impact to the net operating income. Good questions, though. Thank you. Any other questions? So again, I'm going to pop my contact info in the chat. If you have any questions, anything you'd like to see some more information, I try to do my webinars a little bit quicker, a little bit higher level, and then see if there's questions. I'm happy to stay as long as everybody wants to stay. But the first few webinars, we can give you recordings of past webinars. Sure is much more detailed than I am. Very detailed man. He's an amazing guy. Yeah, and then if someone else brought you to this particular webinar, so if you were invited by someone other than myself, you would just reach out to them for the information and their investor link.
Okay.
Very good. Awesome. Well, I appreciate everybody showing up. I hope everybody has an amazing 4th, that you get some good time with your family and loved ones. And I'm having my hamburgers tonight. So that's my treat after I'm done here. Maybe I was hungry. That's why I talked fast. I don't know, but I usually talk fast. So again, appreciate you coming here. If someone brought you to this webinar, just reach back out to them. And if it was me, you can reach back out to me, and you can talk to me. You can and invest with them however you want to work it. I want to make sure that you understand what you're doing, and I hope that you make a decision to invest in along with us and be our partners. Awesome. Thank you, everybody. Enjoy the rest of your week and your evening and your weekend. Take care. Thank you.
Bye now.